Big rises, God candles, and comebacks when the world economy almost went down. That's what people remember and retain about Tesla. Whether you are in for the long run or for the short-term flips, it's hard to overlook the perceived potentials of this major player swimming in the waters of Nasdaq. So, regardless of if you hate, like, or doubt it, Tesla remains one of the biggest names in the financial market and the mainstream. Very few were able to imitate its comeback, let alone its glories, over the course of like 15 years. And to convince the market at large that a company making expensive cars with very highly polluted metals is the answer to all our pains, this is already a feat on its own. And yet it has succeeded and created one of the biggest bullish surges in recent memory. But nevertheless, the uncertainties around currencies, inflations, political and geopolitical issues have blurred the market's capacity to remain optimistic forever and ever, while waiting for EVs to save the world. Many are now simply hoping to survive. And over the past few years, if there were anything that has significantly altered our perception of reality and shaken up our assumptions, few things have done more to damage this perception than the change in the labor market and the inflation. Many people lost their source of income, sometimes their only source of income for an entire household. Others are now fearing losing theirs after seeing their once flourishing companies overhiring during the pandemic, assuming that that's going to be the new normal, then having to double down the other way around to overcompensate for their mistakes. Millions of people are now navigating with a lot of uncertainties of disappearing labor demand, as well as spikes in the inflation. Because stay-at-home policies, in the end, were expensive, and the collective had to foot the bill, no matter how unevenly it has been done. So money is harder to make, and even for those who have any, it's quickly losing its value. So taking our affairs in our own hands should be the first step towards our financial freedom, and finding the golden goose is the quest that we should take on. Tesla is definitely one of the stocks that should remain on top of people's mind, not only to profit from its price fluctuations, but to read the big picture through the movements. So in this video, we're going to take a deep dive into Tesla and see what's the best course of action given the current circumstances. And before the video continues, I just want to take a moment to thank you for coming to my channel and hope that you can enjoy your stay and to come back for more content. If you like what you see, please like, subscribe, and check out my channel for playlists of the companies I cover. With that being said, hopefully you're going to enjoy my video today, and let's get started. So over the past few days, Tesla has been priced at around $262, now confirming and continuing on its bullish price action in the short run, reversing its previous price action trends. There were lots of ups and downs following the multiple splits that Tesla had over the past few years, which were also its most glorious ones, and by far. So the market suddenly discovered, or pretended to suddenly discover, the potentials of a previously niche corporation with a flamboyant CEO. So at the moment, the market is reacting to the sales number of the infamous Cybertrucks, and FOMO is probably the main reason why the current wave of uptake occurred. But of course, there are many more reasons to explain why Tesla, or to explain after the facts, why Tesla could have a bumpy ride. So the market has been initially expecting more positive news from one of the biggest corporations in the world, when Tesla released only mixed signals or no signals at all for many months. The global markets entered into recessions and uncertainties when cars are only needed when there are optimism and investment. Rare earth are being qualified as highly toxic and challenging to mine and extract, and also the local humanitarian concerns for wherever we can find those rare earth also raises a few eyebrows. EVs are still too highly priced for mass adoptions, and sometimes too inconvenient as well, especially when there are cheaper hybrid cars or even cheaper EVs from other traditional manufacturers. And then, thanks to the sales numbers, Tesla's price action recently also took off. I would say that the macroeconomic tendencies may also explain Tesla's sudden price action, where a strange musical chair has been playing. So, Nvidia and Alphabet and Tesla could be part of something like a musical chair, right? At least one of these three titles may have a good run in the market at any point in time. There could be more, but at least one of the three, probably due to the market's inherent need to have a niche for capital preservation as well as profit generation. There could be more subjective reasons as well, like the influence of Elon Musk, the macroeconomic cycles, and the shift of narratives. Many of those reasons can also explain why Tesla has been often sold off when it came near the $200 psychological level, when its relatively high baseline is often seen as a natural barrier or a natural profit-taking level by those who would prefer to safeguard their capital in uncertain times. And for a period of time, the market was unsure about Tesla's relevance and its place after the huge surges back in 2020. And right now, things are moving at an increasingly rapid and unpredictable way. When there are enough of them, it's only a matter of time before they decide to collectively just, blossom simultaneously, and then to create some sort of new market dynamics. So what the current price action is telling us is that Tesla has gone through some consolidation after many years of growth, and right now the market still wants to believe that this stock can give them a lot of miracles. The financial data released by Tesla on a quarterly basis, quarterly and then annual basis, are very important for the company's outlook. But of course, given what Tesla truly is, its future fortune doesn't only depend on numbers. With that being said, they serve as a safeguard of the existing baseline. And over the past few quarters, things could have been better. Despite having a net profit, which was the main reason why back in 2020 Tesla became such a highly valued company to begin with, its profit margin and cash flow figures were all getting worse on a year-to-year basis. Profitability is probably the most significant financial figure that may influence Tesla's price action because it has a symbolic meaning that goes way beyond the company's scope. And because it's such a large corporation, its well-being does carry weight and does, makes waves for the rest of the sector. So a Tesla that makes money will often be viewed as the sector that makes money. So the rest of the market will probably follow Tesla in both share price, outlooks, and sometimes even profitability. The other element to watch is the growth. Since it's currently one of the most highly valued companies in the world, the ratio of profit to equity is much higher than your typical blue chips. And in fact, people are not paying the blue chip price. They're paying a huge premium to own Palantir now so that it can fulfill its promise made to the market. Maybe like a tacit promise that things are going to be on the up and up. And this is why any decrease of not only the profitability itself, but of the growth rate of the profitability or the revenue will always greatly affect the market cap. Because remember, how is a Ford valued? How is a Toyota valued? How is a Stellantis valued? And then you look at Tesla, you look at the ratios. They're not playing the same game. But should that be normal? Right? You don't want people to start thinking like that. As soon as this happens, I feel like we're going to have a field day with Tesla. Or rather, the short sellers of Tesla and the naysayers are going to have a field day. Of course, most people interested in Tesla won't make any decisions based on numbers of the financial statements. but of the evolution of the market dynamics. In other words, most of us buying Tesla are not expecting to get rich on its dividends, but a quick appreciation on the share price. We buy into success stories and keep trending off the ongoing narratives about, energy transitions, alternative mobility solutions, how EVs are going to take over the universe. So the appeal of those narratives may be the advancement of technological capabilities, but also different formulas to calculate companies like Tesla or Lucid or Rivian compared to Toyota and Ford. So Tesla began with a bold statement about the future of zero-emission vehicles when they first started the trade. And for many years, the market has been skeptical about the feasibility of these missions. And it actually got to a point where the company was about to get sold, or at least, trying to get sold before the breaking point the break-even point has been reached. And the surge in popularity as the world came to a halt in 2020 quickly erased those past stories in our collective memory. So it also coincided with the announcements of many countries deciding to ban the sale of combustion engine vehicles from 2030 onwards, especially in the Northern Hemisphere. This mentality has been able to establish itself in the investment and trading community over the next couple of years, as simple mentions of EV may bring you billions of investment. People were not investing, they were fleeing into glittering life pods. The market being a self-fulfilling prophecy with simple math behind supply and demands, the share price of Tesla ultimately reflecting the optimism at the time, which was absolute. So in fact, even when the market started to doubt about the relevance of the sector itself in the long run, when there are more investment options to safely park your money into, even when an increasing number of people talk about it like an industrial chain instead of a Silicon Valley maverick, Tesla does benefit from a more indulgent, patient, and richer fan base. What this means is that while many other brands like Rivian, Nikola Fisker, Molen, or Lucid have all but collapsed under the weight of time, Tesla is simply having a relative sell-off. So for me, this is a very important appeal of Tesla, since it has enough gravity on its own to hold on to a pretty high baseline, so that its accumulated gains over the past few years don't melt away. And this is something that's really rare as things go in EV. Simply put, it's a major player in a sector that absorbs all the glories and many of the backfires. It has enough demand in terms of shares demand to maintain a fairly high baseline below which many people would prefer not to short sell, because potential losses being unlimited and the likelihood of short squeezes higher than the average because of the status. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So, this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. So, having said all this, I think that Tesla is very much the spearhead of its sector, and the price action determines whether the market still believes in its long-term relevance. The fundamentals of Tesla are good at the moment, but of course it doesn't just depend on that. And its dominance within the current, like whatever EV is currently defined or valued at, is just an empirical fact. Its main concern is the market cap calculation or any change in the narrative, as well as some real world challenges and practices that might be exposed, which may cause a lot of bad press for the company. For example, if they're having problems selling their cars in some parts of the world, or if they're forced to store their cars somewhere in some abandoned parking spot, then yes, this is only going to worsen the issue, right? So we previously warned about the $200 level, and now I think it's the $300 level that we gotta be careful with. Like if it nears the $280, then we gotta think before we move, right? So with all that being said, I would say that if you believe in the long-term relevance of EV sector, then yes, having some Tesla in your portfolio is recommended. If you think that this sector you don't know enough about it, or if you don't feel comfortable trusting your money in it for the long run, then there are better opportunities in other sectors. So if you want to buy Tesla, I would say to start trickle in now. over the course of the next 2 years and hold it for about 3 to 5 years. And your maximum exposure should be between 8 to 10% of your portfolio.